Good afternoon and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending March 22nd, 2024. I'm host of InvestTalk, Justin Klein. Thank you for tuning in, liking, and subscribing to this channel as well as our podcast, InvestTalk. Now, this week I'm going to title the video, A Dovish Fed Cannot Save Tesla. And Tesla was the darling for a long period of time, and it's starting to fall from grace. And I'll talk about that uh, and why that might be. But let's dig into the economic numbers here for this week. We had on Monday, we had the Fed's business leader survey of current economic activity. Look how negative it was for many quarters. Most of last year, this was in negative territory. Look, I mean, you go all the way back to the fall of 2022. And all of this minus what you had 1.6, and you have one more 0.6 positive. So what that's showing you is that this is bottomed last fall, in the fall, -19, and continues to kind of march higher. So obviously the business leaders are becoming more optimistic about the overall economy. Then if you look at the housing market index, that also ticked up into positive territory. This is one of those things where if it's above 50, that is the majority of home builders feeling good about the underlying market that they're selling into. And it's the first time it's been above 50 since last summer. And you can see how strong it was back in 2021, 2022 when prices were booming, and then obviously it fell off a cliff kind of late in 2022. So that's starting to get better. You can see that the housing starts, that was up 10% month over month, and you can see that kind of bottomed back late last summer. 1.3 million units, now are at 1.5. Still not gangbusters, but certainly a more robust market. What you can see is everyone who was bearish, home builders, thinking the housing market is going to fall off a cliff, just wasn't the case. The underlying dynamics did not make sense. And then if you look at the existing home sales, what you're seeing is inventory is rising, but it's being met with enough demand, and you're starting to see existing homes move, and that is a positive. Now you could argue, hey, maybe this is a negative for the home builders now that there's some competition from existing homes, but still, obviously, based on these other numbers, they're feeling good and everything looks good on their end. The job side, you saw continuing claims tick up a little bit, but this is kind of in a consolidation pattern, not a breakout in continuing claims, meaning the jobs market, although weakening overall, it's not a bad jobs market. We see the unemployment rate that ticked up to 3.9 in the month of February. And we're coming into another jobs report here, not next week, but the week after. So we'll get an update on March. Now, Wednesday was the Fed announcement, and it was a bit dovish than the market had been anticipating. In fact, you even have in the May meeting a 12% chance that there will be a cut. That's how dovish the market interpreted their data, despite all the other economic data resurging, as well as the cyclical parts of the market, which we'll talk about in a bit, getting some strength as well. So you're seeing that the Fed is dovish, even though the economic data seems relatively fine. You can see that with June, you have a 75% chance, basically, of one or two rate cuts by June. It's not that far. We're almost through March now. So you're talking sometime next quarter, and this quarter is over. The first quarter is over at the end of this upcoming week. So, it still seems imminent. It was interesting as their dot plot still said 3 rate cuts by the end of the year. They only have 6 more meetings. So basically every other meeting, the expectation is a rate cut. And that's why in September, you have a 45% chance plus, right? Basically a 90% chance or 80% chance, excuse me, that there will be 2 rate cuts or more by September. And then by year end, you still have kind of base case somewhere in that 3 to 4 rate cut environment. So it'll be very interesting. The markets are at all-time highs. Does the Fed really need to cut? Probably not, but we'll see as we go along. And obviously, the dollar has gotten stronger. I'll show you that. And that's what's even more interesting is that commodities still remain robust, even though the dollar has had a little surge this last week. Pretty strong move here. And then if you look at, let's take a look at some of the commodity spaces. XLE, here's energy, that's looking strong. Industrials also remain strong. Obviously, we had a sell-off on Friday. But if you look at, the XME, that one is starting to gain some strength and continuation of its uptrend that started last fall. This is the metals and mining index. And gold has just consolidated up here above $2,000 an ounce. Around 2,200 is the actual price, and probably headed over up to 2,300. So despite a strong dollar this week, the commodities just consolidated, and I think they're headed higher because the economic data, both domestically as well as stimulus coming out of China, are likely to push the demand for raw materials higher, energy higher, etc. So that is really what the market is looking like. Is that rotation is in earnest here? You see that here's the S&P at an all-time high for the close for the week. We were down 7 points on Friday. The Nasdaq, that was up 27 points on Friday and closed at an all-time high. Let's see, what else do we want to get to? Oh, Tesla, because that's what we're talking about here. And look at this downtrend. This is the daily, and you say, okay, hasn't broken this low here from last spring, but clearly we're in a downtrend since basically last summer. But let's zoom out to a weekly, and you say, no, we've been in a downtrend since the end of 2021 when growth stocks peaked out. Okay, and interest rates started going higher. And this is a very bearish setup, right? You break this long-term uptrend, you attempt to recover it, and you do not make any new higher high here, right? You see this three lower highs and a breakdown and a retrace and then another failure here. This is a very bearish setup. And then you accompany this with the fundamental data, and that is earnings. And so what you can see here is this is the estimate summary. So let's start off here with this chart. Consensus trend. So the yellow is 2027, the red is 2026, green is 2025, and blue is this year. And the consensus, we're going all the way back to, let's see, the August of 2022. And what you can see is this year's earnings were expected back then to be about $7.50. What is that now? It's under $3. Under $3. Next year's now $4. 2026, $5. Right? This trend is very, very negative. And then you look at the relative valuation here. You're trading at 53 times next 12 month expected earnings. 53 times. That's 2.5 times the multiple that the S&P trades at. Okay. Now you say, okay, what about some of the other multiples? Well, let's go price to book. It's trading at about 2 times what the S&P is trading at, 1.87. So 8.7 times book. Then you go to price to sales. 6 times higher than the S&P. Trading at, 6 times higher. Twice as high. It's trading at 6 times sales. Okay, 6 times sales. And then EBITDA, 38.7 times EBITDA. When you get to 20, that's elevated. Sometimes that's justifiable. It's a very, very good business, but we know that the EV market is weakening. We know the car market is very competitive and a tough business, very capital intensive, and it tends to trade at low multiples, not high multiples. And then you layer on top of this, think of the AI craze. How much does Tesla really play into that? Really doesn't. Right? And the hot name is no longer Tesla, it's Nvidia or Supermicro or AMD. And so money is flowing out of what is in a downtrend and into many of the stocks that are in an uptrend, right? There's Nvidia. So The trend in the stock is very bearish. The earnings consensus is very bearish. Money flow is obviously bearish. And, could this be the wholesale re-rating of Tesla to more reasonable valuations? Should it trade at double the multiples of the S&P when, the expectations for sales growth are flat to negative and earnings growth flat to negative? I don't see why it should. So this is looking like your classic Eiffel Tower formation where you have this big surge higher. This is a monthly chart. And it fails at the top, and then you go into pretty much a secular decline back to the pre-breakout prices, which frankly, you're talking in the 20s, 30s. Would not shock me to see Tesla sub $50 per share over the next 24 months, maybe 36 months, but somewhere in that 2 to 3 year range, especially if these earnings trends continue to remain very weak. So I wanted to highlight that because it's probably the most under discussed story in the markets right now. Now let's see, what else do I want to get to? Let's look at the credit markets. So we know that in order to get a deflationary impulse, you're going to need to see the credit markets weaken. Now, the last couple of days, you saw a little bit of weakening, but this is just still an uptrend. And this is short-term junk to short-term treasuries. Okay, so there's nothing about this that is worrying, that's signaling some sort of risk-off events, credit spreads widening, etc. This was interesting. I'll be very interested over the next couple of weeks to see, can the banking index break out? So this is the KBE, and this is a consolidation pattern. There's nothing wrong per se of this pattern. But if you compare it to like the XLF, look at this. That's, that's a strong pattern broadly for the financials. But the banks itself, they're not doing very, very well. Right? You look at things like the broker-dealers. So these would be the investment banks, typically. But the commercial banks, this is actually lower highs, lower lows. Right? That's not really in an uptrend. It's pretty much in downtrend since it's December. So that's something I'm watching as well. My wife said, I don't love the banks. If you're looking at financials, I think that's fine. But banks usually are the least attractive in this environment. And, a lot of it has to do, I think, with, the fact that the 10-year continues to kind of march higher here. Right? You pull up an IEF, this surge on the Fed pivot. But what is this? Is this telling us that this is going to roll over once again? And the simple answer to me is, yeah, I think interest rates are headed higher, not lower. You see that with the trends in inflation over the first couple months. Inflation has been surprisingly upside. And then if you look at, here's the USO, look at energy trending higher. So are we headed for not just a soft landing, but a no landing scenario? Meaning, does the Fed not cut at all? Right? It's so really interesting about this week's Fed meeting is that what about the current environment, besides, the jobs market's getting a little weaker, but I mean, it's still 3.9% unemployment. Not bad. There are some lower ends of the income spectrums that are struggling. And you see that with like a Dollar Tree, right? They're shutting down a bunch of stores. Saw that with their earnings. So there are pockets of weakness in the economy, but overall, middle to high income, they're doing well. So are we headed for a Fed that is not going to be dovish, but they're actually going to have to get more hawkish, which means rates going higher? Do we get through, once we get through the tax season, is the Treasury going to have to start issuing more debt? Is that going to put pressure on the bond market? And thus the Fed maybe is going to have to pivot then. And then what happens, right? Pivoting with a strong economy, does that weaken the dollar? Does that get inflation to resurge? And maybe that's what gold is sniffing out here. That even though the economy is fine, the inflation numbers are trending higher, that the Fed is going to pivot nonetheless and drive the long end of the curve up. And so it's a very interesting scenario that the Fed is in going into the back half of this year. So, to sum it up here, I would say near term, I would say I'm mildly bearish, but not much, right? I think the market certainly needs a breather, certainly needs a refresher, but not anything that's likely to create a deflationary impulse. Once again, because the Fed can't allow that with the amount of debt that we have. So seasonality, this is a time where you tend to get a breather in the market, March, April, May, June timeframe. And then June, July is pretty good. August, September, usually okay. September is usually the worst of the months, but that's usually colored by a handful of really bad months. So easily could be a strong September as we head into election season, which typically is very strong, right? The entire full year, election year, when there is an incumbent trying to get reelected, that typically is a strong year, double-digit returns. And so, despite the fact that we'll likely get market gyrations, the trend remains higher, both for asset prices and I think for inflation. I think cyclicals are starting to really resurge. So, yeah, that's my summation for the market for this week. Very interesting week, that's for sure. And continue to focus on that rotation because money is starting to flow out of tech. You're seeing a a slowdown in that momentum, right? Look at the SMCI, for example, and that momentum has certainly waned. Bitcoin, obviously, that one, excuse me, BITB, that has started to wane as well. And if these break down, I think that's going to drag the broader market with it. So, and I'm actually watching Bitcoin. It's usually a leading indicator is to liquidity in the marketplace. So, if that breaks down below 60,000 on Bitcoin, I think that's certainly an indicator that, hey, the broader equity markets could break down as well in the near future. And when I say break down, start a market pullback, nothing dramatic, right? Right now, you see Bitcoin right around 65,000. So that about does it for this week. I appreciate you all tuning in, liking, and subscribing once again. And a reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.